When it comes to global trade, two key indicators help us understand what's happening behind the scenes: the Baltic Dry Index and the Freightos Baltic Index. Understanding these indices can help us anticipate economic shifts before they become evident in traditional market data. Hi, I'm David, a financial analyst with over 30 years of experience specializing in currencies and commodities. Today, we'll take a quick look at what these indices reveal about global trade. What is the Baltic Dry Index? The Baltic Dry Index, BDI, measures the cost of shipping dry bulk commodities, such as minerals, coal, grain, and ferrous metals. It does not include the transportation of oil or gas, which fall under separate indices. Despite its name, the Baltic Dry Index is not limited to the Baltic Sea region. It reflects shipping costs across major global trade routes. What is the Freightos Baltic Index? The Freightos Baltic Index, FBX, on the other hand, tracks the cost of container shipping, which is primarily used for transporting finished goods. If the Freightos Baltic Index declines, it may indicate weakening global demand for products or simply an oversupply in the shipping industry. What are the charts telling us? The Baltic Dry Index saw a sharp decline between October 2024 and January 2025, but rebounded strongly in February and March. The Freightos Baltic Index, however, has been in continuous decline since early 2025, suggesting potential weakness in the trade of finished goods. So what's really going on? Are the Baltic Dry Index and the Freightos Baltic Index warning us of a global economic slowdown? Or could there be another explanation? Let's analyze the data more closely to understand why these indices are declining and what their implications might be in the coming months. Why are Baltic Dry Index and Freightos Baltic Index declining? I have analyzed real data, not just forecasts or market fears, so the question remains, why have the Baltic Dry Index and the Freightos Baltic Index been declining since September-October 2024? Is this a direct signal of a global slowdown? The Baltic Dry Index saw a sharp drop until January 2025, but rebounded strongly in February-March. This suggests that bulk commodity shipping has picked up again, possibly due to a recovery in industrial production or seasonal factors. The Freightos Baltic Index, on the other hand, has been in continuous decline since early 2025, indicating that the shipping of finished goods is slowing down. This could be a warning sign for global consumer demand. A possible explanation is that the decline in the Freightos Baltic Index may be more about excess shipping capacity rather than a true collapse in demand. Meanwhile, the Baltic Dry Index's rebound suggests that the industry is not yet in recession. However, if this divergence continues, it could be the first signal of a weakening global trade environment. Is this the beginning of a global trade slowdown? Data from major ports suggests that volumes remain strong: Shanghai, Rotterdam, and Los Angeles, although some concerns persist. The specific figures are not included here, but can be consulted on the respective port websites. Shanghai and Rotterdam have seen an increase in container traffic, indicating that global trade is not yet in decline. Los Angeles is experiencing strong import growth but weak exports, with large numbers of empty containers being sent abroad, a clear sign of worsening trade imbalances. It's possible that global trade isn't actually shrinking, but rather that regional trade patterns are shifting. The U.S. is importing more than it exports, widening its trade deficit. The shipping industry is adjusting to evolving trade dynamics, leading to a more balanced, but lower demand for transport capacity. Weaker demand in emerging markets and Europe could start to weigh on global trade flows. Only if the Freightos Baltic Index continues to decline while volumes at major ports begin to drop will it be a clear confirmation of a global trade slowdown? The impact of tariffs on U.S. exports and trade balance risks. A critical factor is how Europe, Canada, Mexico, and China respond to Trump's tariffs. If these countries impose retaliatory tariffs on United States goods, already weak United States exports could decline even further. As a result, the United States trade deficit would widen, exacerbating the country's debt. To finance the growing deficit, the U.S. government would need to issue more debt, increasing pressure on Treasury yields and the U.S. dollar. If retaliatory tariffs lead to a drop in United States exports, global trade could genuinely begin to slow, and the divergence between the Baltic Dry Index and the Freightos Baltic Index could become a clear crisis signal. Are we really close to a crisis? Global trade is not yet in crisis, but growing imbalances are becoming evident. The decline in the Freightos Baltic Index may be more a result of shipping overcapacity than a real drop in demand. The Baltic Dry Index's recovery in February-March suggests industrial production remains stable, but if it starts to decline again, that would be a stronger recession signal. The real danger lies in the impact of United States tariffs and global retaliation, which could escalate into a full-scale trade war with serious consequences for United States exports and global commerce. If upcoming data on ports, international trade, and tariffs confirm this trend, we could indeed see a worsening global outlook in the coming months. Now, I would love to hear your thoughts. Do you think Trump's trade policies could actually trigger a trade war, or are tariffs simply a negotiation tool? Let me know in the comments. Thanks for watching. If you found this video useful, support the channel by leaving a like and subscribing to stay updated. Turn on notifications so you don't miss future content. See you in the next video.